You know what's fascinating? While everyone's arguing about whether gold is in a bubble, something extraordinary is happening behind the scenes. And if you own physical bullion right now, you're positioned on the right side of one of the biggest wealth transfers in modern history. Let me show you what I mean. Gold just crossed $3,400 per ounce. Silver's pushing toward $35. And here's the thing that should make your ears perk up. This isn't retail investors driving these prices. It's not Reddit forums or YouTube hype. The smart money, the institutions that move billions with a single decision, they're accumulating physical metal like their lives depend on it. Central banks bought over 1,000 tons of gold in the past year alone. That's the third consecutive year of record purchases. Think about that for a second. The very institutions that print money are converting that money into gold at the fastest pace in half a century. What do they know that the average person doesn't? Here's where it gets interesting. The World Bank just published data showing that gold, silver, and platinum prices have all surged as investors flee to safe assets. But it's not just about safety anymore. It's about survival in a system that's fundamentally changing. Let me paint you a picture of what's really happening. Remember when your dollar could buy a decent meal for under $5? When gas was $2 a gallon? When a house didn't cost 7 times your annual salary? That wasn't that long ago. But here's the uncomfortable truth. Your dollar hasn't gotten weaker by accident. It's been systematically devalued, and the pace is accelerating. The Federal Reserve has printed more money in the last few years than in the previous century combined. Every time they fire up those digital printing presses, your savings lose purchasing power. It's not inflation in the traditional sense, it's currency debasement, and it's happening faster than most people realize. But bullion owners? They're watching their wealth grow in real terms, not because gold and silver are going up, but because everything else is going down relative to real money. Here's a story that illustrates this perfectly. In the early 1970s, an ounce of gold cost $35. A decent suit cost about $35. Today, gold is over $3,400. That same quality suit still costs about an ounce of gold. The gold didn't change. The dollar did. The suit didn't change. The dollar did. Everything priced in dollars looks more expensive, but priced in gold, purchasing power has been preserved for over 50 years. That's not an investment. That's insurance against monetary madness. Now let's talk about what's driving this current surge, because understanding the mechanics will show you why bullion owners are winning. First, there's the geopolitical shift. The BRICS nations, Brazil, Russia, India, China, South Africa, plus dozens of others joining. They're actively working to reduce dependence on the US dollar. They're not doing this quietly anymore. They're announcing it at summits, signing bilateral trade agreements in local currencies, and backing those agreements with gold reserves. China's been accumulating gold for years, but they've accelerated recently. Russia converted a massive portion of their foreign reserves to gold before recent sanctions. Even countries traditionally aligned with the West are diversifying away from dollar-heavy reserves. This isn't conspiracy theory. This is official central bank policy you can verify on their websites. When central banks buy gold, they're making a statement. We don't trust the current system to last, and they're voting with billions of dollars. But here's what makes this different from previous gold rallies. In the past, gold would spike during crisis moments, then retreat when things calmed down. This time, gold's rising despite relatively stable markets. It's rising while stock markets hit new highs. It's rising while real interest rates are positive, which traditionally should suppress gold prices. Something fundamental has changed in how institutions view precious metals. They're no longer just crisis hedges. They're becoming core holdings in a world where currency stability can no longer be assumed. Let me give you some specific numbers that tell the story. JP Morgan's research division projects gold prices will remain elevated through the coming years, driven by what they call structural demand from ETFs and central banks. That's banker speak for "this isn't going away." The World Gold Council reports that gold-backed ETFs saw massive inflows recently, reversing years of outflows. That means institutional money, pension funds, sovereign wealth funds, they're all rotating into gold. These aren't speculators. These are long-term holders with trillion-dollar portfolios making strategic allocation decisions. And here's the kicker. Most of this demand is for physical metal, not paper contracts. The premium for physical gold over paper gold has widened significantly. That spread tells you something crucial. People want the real thing, not promises. Which brings me to silver, and why silver owners might be winning even bigger than gold owners. Silver's in a unique position. It's both a monetary metal and an industrial metal. While gold sits in vaults, silver gets consumed. Solar panels, electronics, electric vehicles, medical applications, silver is being used up faster than it's being mined. The above-ground stockpiles that existed for decades, they're nearly depleted. Here's a number that should shock you. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. For most of human history, that's where it sat. Today, it's still above 90 to 1, even after silver's recent gains. If that ratio reverts even halfway to historical norms, silver owners are looking at massive gains relative to gold. But there's more to the silver story. Industrial demand is exploding. Every solar panel requires about 20 grams of silver. The world is installing solar capacity at record rates. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure, medical devices, water purification, the list goes on. Silver is being consumed in applications that didn't exist a generation ago. Meanwhile, silver mining is struggling. Most silver comes as a byproduct of copper, lead, and zinc mining. When those base metals aren't profitable to mine, silver production drops. We're seeing mine closures, project delays, and declining ore grades. The supply side is constrained while demand is accelerating. Do the math. Declining supply plus rising demand equals higher prices. It's not speculation, it's arithmetic. Now, if you're sitting on retirement accounts, IRAs, 401ks, and you're watching this unfold, you might be wondering how this applies to you. Most retirement accounts are stuck in paper assets, stocks, bonds, mutual funds, all denominated in dollars, all subject to the same currency debasement we've been discussing. Quick aside here, and this is important if you have significant retirement savings. If you're sitting on $100,000 or more in retirement accounts, there's a way to get physical gold and silver into those accounts without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. It's in the description below, covers the mechanics, the rules, the companies that facilitate it, everything you need to know. Worth checking out if protecting your retirement purchasing power matters to you. All right, back to why bullion owners are winning. Let's talk about what's happening in the physical markets because this is where things get really interesting. There's a growing disconnect between paper gold prices and physical gold availability. The COMEX, the major futures exchange where gold is traded, has seen its registered inventory, the gold actually available for delivery, drop to concerning levels relative to open interest. What does that mean in plain English? More people hold contracts for gold than there is gold available to deliver. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone wants their gold at once. We've seen this movie before. In 2008, during the financial crisis, premiums for physical gold coins and bars spiked massively over spot prices. Dealers were sold out for months. People holding paper gold couldn't convert to physical at any reasonable price. But people who already owned physical bullion? They were sitting pretty. The same thing happened in 2020 during the pandemic panic. Mints couldn't keep up with demand. Premiums exploded. Delivery times stretched to months. Paper gold traded at one price. Physical gold traded at a significant premium. Here's the lesson. In times of stress, paper promises and physical metal diverge. And we're heading into a period where stress is likely to increase, not decrease. Think about the debt situation. The U.S. national debt just crossed $36 trillion. That's trillion with a T. The interest payments alone are approaching $1 trillion per year. That's more than the defense budget, more than Medicare. The debt is growing faster than the economy, which means the debt to GDP ratio is rising into territory historically associated with currency crises. How do governments deal with unpayable debt? Historically, there are only three options: default outright, which destroys credibility, raise taxes dramatically, which kills economic growth, or inflate the currency, which reduces the real value of the debt. Guess which option is politically easiest? Inflation. Every time. And that's exactly what we're seeing. The official inflation numbers are carefully managed to look moderate, but anyone buying groceries, paying rent, or filling up their gas tank knows the real story. The cost of living is rising faster than wages, faster than official statistics admit, and faster than most people's savings can keep up with. Unless those savings are in bullion. Here's another angle that's not getting enough attention. The energy crisis and its impact on mining. Mining gold and silver is energy intensive. As energy costs rise, mining becomes less profitable. Marginal mines shut down. New projects get delayed or canceled. This constrains supply exactly when demand is rising. We're already seeing this play out. Major mining companies are reporting declining production. Exploration budgets have been cut. The pipeline of new mines coming online is the thinnest it's been in decades. It takes 10 to 15 years to bring a new mine from discovery to production. The decisions made today determine supply a decade from now, and those decisions are being made in an environment of high costs, regulatory challenges, and capital scarcity. The supply side of precious metals is facing structural headwinds that won't resolve quickly. Meanwhile, demand keeps growing, not just from central banks and institutions, but from individuals who are waking up to the reality of currency debasement. In countries experiencing currency crises, Turkey, Argentina, Lebanon, Zimbabwe, gold and silver become the only reliable stores of value. People learn fast when their life savings evaporate. The Western world has been insulated from this reality for decades, but that insulation is wearing thin. When you see homeless encampments in cities that were prosperous a generation ago, when you see middle-class families struggling to afford basics, when you see young people unable to buy homes despite working full-time, these are symptoms of currency failure in slow motion. Bullion owners are protecting themselves from this slow-motion collapse. They're preserving purchasing power while everyone else watches their savings erode. Let me give you a specific example of how this plays out in real life. Imagine two people. Both saved $100,000 over their careers. Person A keeps it in a savings account earning minimal interest. Person B converts half to physical gold and silver. Over the past 5 years, Person A's $100,000 is still $100,000 in nominal terms, maybe $105,000 with interest. But in real purchasing power, accounting for actual inflation in housing, food, energy, healthcare, that $100,000 now buys what $70,000 bought 5 years ago. They've lost 30% of their wealth without realizing it. Person B's $50,000 in cash has the same problem, now worth about $35,000 in real terms. But their $50,000 in gold and silver? Gold has more than doubled. Silver has gained significantly. Their precious metals are now worth over $120,000. Total portfolio, $155,000 nominal, but more importantly, they've preserved and grown their purchasing power. That's not a hypothetical. That's the actual math of the past 5 years, and the trend is accelerating, not slowing. Now, some people will argue that gold and silver don't pay dividends or interest. They just sit there. And that's true. But here's what they're missing. In an environment of currency debasement, the return isn't from yield. The return is from not losing purchasing power. When your currency is losing 10 to 15% of its real value per year, earning 2% interest means you're still losing 8 to 13% annually. Bullion doesn't lose value. It maintains value while the currency around it collapses. That's not an investment strategy. That's a survival strategy. And here's something else that's not widely understood. Gold and silver are no one else's liability. When you hold physical bullion, you're not dependent on a bank staying solvent, a government honoring its promises, or a company remaining profitable. It's yours, completely, with no counterparty risk. In a world where banks can fail, governments can default, and companies can go bankrupt overnight, that matters more than most people realize. We saw this in 2008 when Lehman Brothers collapsed. We saw it in Cyprus when bank deposits were confiscated. We saw it in Greece when capital controls were imposed. Physical assets that you control directly become invaluable when systems fail. Let's talk about the technical picture for a moment, because the charts are telling an interesting story. Gold has broken out of a multi-year consolidation pattern. It's making new all-time highs in virtually every currency, not just dollars. That's significant. When an asset is rising against all currencies simultaneously, it's not about one currency being weak. It's about the asset being revalued higher globally. Silver is showing similar patterns, though it's still below its all-time highs from over a decade ago. That actually makes silver more interesting from a technical perspective. It has room to run just to catch up to its previous peaks, let alone make new highs. And given the supply-demand fundamentals we discussed, that catch-up move could be explosive. The platinum group metals are also rising, which tells you this isn't just about gold and silver. It's about physical assets with intrinsic value being revalued higher against fiat currencies. Platinum, palladium, even copper, they're all showing strength. The entire complex of real assets is moving. Here's what the smart money is doing, and you can verify this by looking at 13F filings and institutional holdings. Major hedge funds have increased their precious metals positions. Family offices are allocating more to physical bullion. Even pension funds, traditionally conservative and slow-moving, are adding gold to their portfolios. These aren't retail investors chasing momentum. These are sophisticated institutions with teams of analysts, risk managers, and decades of experience. They're making strategic allocations based on their assessment of systemic risk, and they're choosing physical precious metals as a core holding. When the smart money moves, it's worth paying attention. And right now, the smart money is moving into bullion. There's also a generational shift happening that's worth noting. Younger investors, millennials and Gen Z, are more skeptical of traditional financial institutions than previous generations. They've seen the 2008 crisis, the pandemic response, the inflation surge. They don't trust the system the way their parents did. And interestingly, they're turning to both cryptocurrency and precious metals. They understand that decentralized, non-government-controlled assets have value in an uncertain world. While crypto gets more attention, physical gold and silver are seeing increased interest from younger demographics who want tangible assets they can hold. This is creating a new base of demand that didn't exist before. It's not just older investors protecting retirement savings. It's younger people building wealth outside the traditional system. That's a powerful long-term trend. Now, let's address the elephant in the room. What if gold and silver prices drop? What if this is a bubble that pops? Here's the thing about bubbles. They're characterized by euphoria, excessive leverage, and retail mania. We're not seeing that. Most people still don't own any precious metals. Mention gold at a dinner party and you'll get blank stares or dismissive comments about boomer rocks. There's no euphoria. There's barely awareness. The rise in precious metals prices is being driven by institutional accumulation and central bank buying, not retail speculation. That's a very different dynamic than a bubble. Bubbles pop when the last buyer has bought. We're nowhere near that point with bullion. Could prices correct? Of course, markets don't move in straight lines. But corrections in a bull market are buying opportunities, not reasons to panic. And the fundamental drivers, currency debasement, geopolitical instability, supply constraints, those aren't going away. If anything, they're intensifying. Here's what I think is going to happen over the next few years, and this is based on the trends we're seeing, not speculation. Central banks will continue accumulating gold, probably accelerating their purchases as de-dollarization continues. Industrial demand for silver will keep rising as green energy and technology adoption grows. Mining supply will remain constrained due to high costs and long development timelines. Meanwhile, currency debasement will accelerate as governments try to inflate away their debt burdens. This will drive more individuals and institutions into hard assets. The premium for physical metal over paper contracts will widen as people realize the difference between owning gold and owning a promise of gold. In this environment, bullion owners aren't just winning. They're positioned for potentially life-changing wealth preservation and growth. Not because precious metals are going to the moon, but because everything else is going to the floor in real terms. Think about it this way. If you own an ounce of gold today, you'll own an ounce of gold in 10 years. Its purchasing power will likely be higher, possibly much higher. But if you hold $3,400 in cash today, in 10 years that cash will buy significantly less. The gold preserves and grows wealth. The cash guarantees loss. That's why bullion owners are winning. They've opted out of a system designed to transfer wealth from savers to debtors. from the prudent to the reckless, from the middle class to the financial elite. They've chosen to hold real money instead of currency, assets instead of promises, value instead of paper. And as more people wake up to this reality, as more institutions make the same calculation, the demand for physical precious metals will only increase. We're still in the early stages of this trend. The majority of wealth is still held in paper assets, still denominated in depreciating currencies, still vulnerable to the systemic risks we've discussed. The transition from paper to physical, from currency to money, from promises to assets, that transition is just beginning. And those who position themselves early, who understand what's happening and act on it, they're the ones who will preserve and grow their wealth through whatever comes next. So if you own bullion, physical gold and silver that you can hold in your hand, you're not just winning. You're positioned on the right side of history. You're holding assets that have preserved wealth for thousands of years, that have survived every currency collapse, every empire's fall, every financial crisis. You're holding real money in a world drowning in fake money. And as that fake money continues to lose value, as it must given the trajectory we're on, your real money will shine brighter. Not because it's changing, but because everything around it is collapsing. That's not pessimism. That's realism. And the realists, the ones who see clearly and act accordingly, they're the ones who will emerge from this period with their wealth intact and growing. The question isn't whether to own bullion. The question is how much and how quickly can you acquire more before the rest of the world figures out what you already know? Because once the crowd realizes what's happening, once the mainstream catches on, the premiums will explode, the availability will vanish, and the opportunity to position yourself advantageously will have passed. Right now, you can still buy physical gold and silver at reasonable premiums. You can still find inventory. You can still act before the rush. That window won't stay open forever. In fact, it's closing faster than most people realize. So if you own bullion, congratulations. You're winning. You've made one of the smartest financial decisions possible in this environment. And if you don't own bullion yet, or don't own enough, now you understand why those who do are positioned so well for what's coming. The transfer of wealth from paper to physical, from currency to money, from the unprepared to the prepared, it's happening right now. The only question is, which side of that transfer you're on.